Hi everyone, hope everyone's well today. We're going to go through today the property and the summer picks of 2018. There's a lot happening in the property market currently. We've got a number of different options where clients can maximise their returns. So hopefully today will give you an insight. As I say, it's not about changing the direction of what you're going. It's just potentially to add another string to your bow. That's it. These webinars aren't to say, right, this is what you have to do, and if we pick a certain area, it doesn't mean that's the only area you have to go to. But again, today's something where we feel that it's another string to your bow where some clients just may not be aware of. So let's start. So in regards to where to invest, we're going to cover that a bit later, but we're looking at a potentially new hotspot. Now, this comes on the back of holiday lets. So a lot of people now know, obviously, that the stamp duty rate changed a couple of years back, and we're paying 3% extra in regards to stamp duty on every tier. But also there are a plethora of other changes that have come into place. For example, wear and tear that you used to be able to claim, it's not as straightforward. You used to be able to claim for your mortgage interest that you were paying. Again, that's now being tapered down, and in a couple of years that would be back down to zero. So things are changing. So what people are looking for new angles. So what's happening as well is you're probably seeing a lot of news and negative news articles where you're seeing, is this the demise of buy-to-let, and is buy-to-let coming to an end? Well, actually, no, it's not. A lot of those articles that you read in the papers, what they're based on is they're based on how many buy-to-let mortgages are taken up. So what they do is they do a spot check every 3 months or every 6 months, and they say, right, in the last 3 months, how many buy-to-let mortgages have actually been taken up? And of course, and those type of mortgages are decreasing. The reason being is a lot more people are now buying in cash, whereas previously they would have maximised the mortgage, but also they're putting it into a company. So what it doesn't take into account is if people are now trying to get around certain tax issues, they will put it into a limited company. It doesn't take into account the fact that those particular properties have been mortgaged through a company. So people are saying that there's less buy-to-let. Well, actually, there is actually more buy-to-let. There's been more buy-to-let purchases in the last year than any other time. The reason why people are saying that there's less is because they're basing it on mortgage transactions, and that's obviously not the way to do it. What they should base it on is actually registrations at the land registry. So what we're looking at, as I say today, is we know it's not the demise of buy-to-let. We know there are plenty of opportunities out there, but again, like I say, we're just looking at other strings to your bow. So where else? Well, if you're looking at holiday lets, and we'll come on to why later, the perfect way to start is you look at the most visited destinations. So one of those is being Cornwall. Now, there's a lot of news articles. If you go to the Times and the Telegraph and the FT, a lot of those travel sections, and they're really promoting Cornwall. Obviously, Cornwall's a very well-known area. It's got a lot of history. It's very expensive in terms of a lot of the properties there. But there are certain areas of Cornwall that are being regenerated. And in some of the areas in Cornwall, they have second home ownership ban, so you can't actually buy to let. However, there are a couple of spots where they don't have any restrictions whatsoever. And they're the spots that will eventually change, and they will eventually change to come in line with the rest of Cornwall. So that's what we advise. We advise people to get in now into areas which are not only going through regeneration, but also where legislation could change. So, for example, in Manchester, you've got a certain amount of legislation coming in where they're only building a certain amount of properties in certain areas. So the actual council are limiting what can be built. Again, that's going to push up house prices because it'll just simply push up demand. Same as in Cornwall, there's no second home ownership ban. So what that will actually do, if you can't own a home down there and people still want to go down there, well, therefore they have to go and rent. And they have to go and rent for the 6-week holidays if they want to take the kids down there. So that drives up rental prices. So what we're saying, if people get involved now, they can then take advantage of this. So if a ban does come in where you can't have second homes, and they won't retrofit that, they won't suddenly say you've got to sell your property. But if a ban comes in, then what basically happens is they'll just turn around, and that will drive the price up because there'll be more demand for your property. There's a couple of sites that we've looked at. One of them has 175 oceanfront apartments. It's a private site with its own private beach. It's next to St Ives, and everyone knows St Ives in this particular area. And as I say, it's a part of the world and a part of the country which is fantastic. It has a huge amount of opportunity in regards to, as I say, not only what I said in regards to the regeneration, but the letting side down there. It's a big thing in England in terms of, if you stay in the UK, especially down south. I know as a child, I used to go to Cornwall quite frequently. It was a 6-7 hour drive from London. But again, we used to go down there with the family quite recently, and it was one of those places where a lot of the elder generation as well would take the grandchildren, and because of that, the rental market is really thriving there. So why holiday letting? Well, first of all, as I mentioned at the beginning, the buy-to-let investor has been squeezed quite dramatically. There's been a number of different taxes, a number of different losses of relief, such as the mortgage, such as the wear and tear. And a lot of people just aren't aware of actually how that's been impacting them, and also they're not aware of what the potential is when they can go elsewhere. So what I'm going to do now is just do a couple of polls here to start off with before we go any further, because we often have a lot of calls after these webinars where some people are actively looking, some people aren't. So I just want to sort of gauge where people are. So in regards to you guys who are on this, how many of you are looking to actively increase your yearly income? Okay, just wait for everyone to vote. Okay. There we go. Okay, so everyone should be able to see that. So we've actually got there 88% who are actively looking, and 13% not. So what we're looking to do, as I say, is obviously show people that are actively looking to increase their income, and we're going to show you over the next few slides what you can do and where you can invest in regards to just getting that extra couple of percent per year. Now, we also have calls in terms of what holds people back. So what I'm going to do is just launch this poll in terms of what actually is holding people back from investing. So some people it's to do with the funds, some people it's to do with the market's going to fall, some people not enough knowledge. So it's good to gauge where everyone is on that, and then we can and then I can run through that as well. We don't have slides prepped for that, but I can just run through that ad hoc. Just wait for everyone to poll. Okay, let's share these results with everyone. Okay, so 38% not enough funds, not enough knowledge, but the majority is, say, the market's going to drop again. I would say that's the biggest thing we get here. We get probably over 1,500 to 2,000 inquiries per month in regards to buy-to-let property, and the biggest issue that just holds everyone back, and it's normally last minute, is they think the market's going to drop. But again, we can cover that in a bit. And again, others is to know the best area. Again, that's how something that we can help with in regards to sort of like the educational side. Well, look, before we go through the rest of the slides, let's cover this. In terms of the funds, unfortunately, guys, that's nothing we can help with. We can suggest ways. A lot of people don't think that they do have the funds, but what they don't realise is that there are certain ways that they can invest. So, for example, we have some clients who have maybe £30,000–40,000 in cash, but they've got no chance of getting a mortgage simply because they're maximising the mortgages that they've got. So what they do is they go into developments which have reassignable contracts. So, for example, they never complete. They will buy something which is worth maybe 250,000. They put 10% down, so it's £25,000. And then 2 years down the line, when it comes up to completion, just before, 3 months before, they will sell that development. Now, ideally, in an ideal market, things move on, and that development may have gone up 10%, for argument's sake. It probably should have done more, but let's say 10%. So that £250,000 development has gone up to 25,000. However, they only had to put down 25,000 in the first place. So in real terms, they've made 100% increase in 2 years on their money. So they've only had to put down 25,000, and they've profited from the other 25,000. They haven't had to pay stamp duty because they haven't completed. They haven't had to pay mortgage fees, again, because they haven't completed. And they've just simply profited from the increase in the property. There is a risk to that. There's two risks. The first one is if you do not sell, you have to go towards completion. And if you don't, then you will lose your initial deposit. That's risk one. Risk two is that the property price falls, so the market falls. Again, a lot of people do this. It's called flipping. A lot of people do it, but you do have to gauge the risks as well. In terms of the knowledge and the best area, well, that's something we can help with, guys. If you're looking to invest, and I think it was 83 or 86% of you at the start said that you do want to actively increase your income, we can help with the knowledge. That's just about taking the time out to speak to a broker. We can't force people to get on the phone and talk, but we do know our stuff and we can help people. It's just a non-obligation chat. So if you guys want to get in touch, just to say, drop us an email after or call in, and we can help you in terms of certain areas. But again, it's got to be something that comes from you, and we will send out independent articles on where we feel the best areas are. Last but not least, think the market's going to drop. Well, that's a big thing. You know, how much do you think it's going to fall by is what I would say. And also, if it does drop, what do you think will happen 3 or 4 years after that? So what I would always say is, it probably will it drop? I think so as well. I don't think in the short term. I think we're probably about 3 years away from a drop. The reason being is I think that we're probably 3 years away because the dips normally take place when you have high interest rates, because that's when people can't afford the mortgages. So if we take the early 90s, when mortgage rates were sort of 14, 15% plus, we had a dip. You take 2008, 2009, again, mortgage rates got to a certain extent where we had a huge amount of negative equity, and people couldn't afford the mortgages. That created the negative equity, I should say, and then house prices fell again. So you typically find it when interest rates are at a low where they are now, and then they start to increase, and people don't factor in. They think actually, well, they're only having to pay another % or 2% on top of their mortgage, but it's not. If they're paying 2% mortgage now and they've got to pay another 2%, their mortgage rate doubles. So what we look at is we look at sustainable investments rather than sort of people who are just scrimping by. I would say make sure that the affordability is there to factor in an increase in interest rate. However, if the market does drop, typically it bounces back. But also, what are you doing this for? You're probably doing, if you're doing this to raise your income, which over 80 of you % said at the start, well, actually the price of the property makes very little difference, because the property price will come back at the end. You're never going to get in at the bottom and out of the top. Very rarely do people actually hit both ends of the spectrum. So actually, your income won't drop. As long as you've got into a good property, into a good area, your income will remain pretty steady. So let's say that you're getting 6% or 7% income. The price of the property becomes irrelevant. The fact is that as long as you get into the good areas, the issue that people do is they think the property price is going to drop. They then wait for 6 months and it doesn't. Then they think, well, it's definitely got to drop now. They wait another 6 months and it doesn't. And then suddenly you're forever waiting for something that actually maybe 2-3 years down the line, and it drops, but not to any extent what you think it's going to. So you've actually wasted an opportunity. My advice would be, if you've got the money and you're looking to increase your income, invest. Doesn't matter whether it's through us, doesn't matter whether it's through another company. It's time to invest, because you're not doing anything with that money in the bank. That's the reality of it. So coming back to the holiday letting side and what else it can offer. So it can give you far better rates of return if it's done properly. With this in mind, we've seen a slight shift coming from a conventional buy-to-let. So over the years, we've seen a conventional buy-to-let, which people always thought was the freehold 2-3 bedroom properties on the outskirts of cities. That then shifted to the apartments, where we're now seeing apartments in city centres. That's where the big buy-to-lets are happening at the moment. So all the big funds are now buying blocks of apartments. We recently had one through us. It was a large pension fund. I can't mention who they are, but they bought Manchester, and they bought over 175 units just off the bat. It was basically 179 units, a mixture of studios, 1 and 2 beds, in the heart of Manchester. And that's what they're looking for. They will get 5.5 to 6% on it, and they're happy with that, and that's a pension fund. So that's where they're going at the moment. So a lot of people now we will see the shift over the years towards holiday letting, because of the tax benefits you can get. So the Office of National Statistics showed that the number of holiday lets in 2016 to 17 rose by 5.5%. I would guesstimate that 17, 18 will be pushing closer towards the 8 to 9%. Now people are becoming aware of what they can offer. A good holiday let, so let's go down to the Cornwall area. A good holiday let, you can easily charge, if you go on to like Airbnb or Owners Direct, you look for a 2-bed property, a 1-bed or 2-bed property, apartment, or even 3-bed in Cornwall, and look what it'll rent for. Some of them you can comfortably see that are going for £1,000, £1,500 per week. So over a period of a month, that's £6,000 a month. You do that for 2 months, that's 12 grand. So a lot of people are realizing that actually I can get as much in 6 to 8 weeks as I can achieve in the whole year. Other advantages of that are it's less wear and tear, because you're only having 8 weeks of wear and tear rather than 52 weeks. So there are other benefits of that. And also it's just all done over a short stint. The downside, of course, well, there's always a downside. The downside is it's not like a yearly rent where you know that there's someone in there day in, day out. You will have to basically, every year, you're hoping that it gets let out. But typically, like I say, if you're buying a decent area, you've got no problem with that. Other advantages, tax advantages. So holiday lets that are fully furnished, and that's key here, fully furnished, are liable to mortgage interest rate relief. Now, again, we legally have to say we're not tax advisors, so I would basically make sure that every single one of you looks at or speaks to an accountant prior to doing this, to make sure it fits in with your criteria, especially the tax side of things. But if it's fully furnished, you're liable to mortgage interest rate relief. Other advantages can include the capital allowances for furniture and fixtures. Again, this reduces your costs and also your so-called profits. You can actually put that through the books, therefore that you're paying tax on a lower amount. And profits can also count as earnings for pension purposes as well. And there are additional capital gains tax relief for traders. Again, you have to make sure this is all relevant to you, because your individual earnings now, which you earn day in, day out from your daily income, can be impacted. So certain things to consider is to qualify as a holiday let, it must be suitably furnished. Again, we can send over this if people want more information on this. I'm happy to send this over. We can send over what the HMRC would class as suitably furnished. It has to be commercially let for a minimum of 105 days a year, or available to let for a minimum of 210 days. So it's not something that you can buy and then you can live in it. It has to be available for 210 days. Now, how they prove that, guys, I do not know. But typically, the majority of people that are doing these kind of lets will be doing these kind of lets through an agent, and an agent can substantiate the fact that it is available for over 210 days, or it will be on a website like Homes Direct or Airbnb, where again, it's got the yearly calendar on there. And again, it has to be the ideal location. So things like Cornwall for me, Devon. Then you head up north, maybe you can get around the Peak District, Lake District, these kind of areas. But again, the reason we like Cornwall so much is because it is something on everyone's lips, where what people are talking about at the moment. It was recently in Savills and the Telegraph as being one of the places to invest. Occupancy rates aren't going to match the long-term market. There's no two ways about it. It's got here, they may not match, they won't. You're not going to have 12 months year-round rental. You're likely to have a lot of Thursday to Monday lets, and you're likely to fill up the majority of half terms, Easter holidays, Christmas holidays, and summer holidays as well. But you probably won't have the same, for example, January the 28th on a Wednesday night, for example, you're probably not going to let it for that particular night. But that's not what you're doing this for. We feel that, like I say, even letting it for 6 to 8 weeks, you can make just as much as a traditional buy-to-let. If you can add Christmas onto that, Easter period, plus the half terms, comfortably, you can make what you make in a year on a traditional buy-to-let, you can make in, what you do in 2 years in a traditional buy-to-let, you can make in 1 year here. So we think that you can double what you're actually making. As I said there, regardless of shorter rentals, they'll far outweigh a traditional buy-to-let. Other things you do have to take into consideration are the fact that you'll need to get the cleaner. You need to get a cleaner, a local cleaner. But again, this is something that we help with. We do a lot of Airbnb style lets. We push people towards this because we feel you can at least double the percentage that you're making. But again, this is something that we can really start to help with. And this is something that we're a one-stop shop in regards to not only the knowledge side, but once you've purchased, we don't just leave you to it. We want to maximize your gains, because if you do, you'll come back to us down the line. So what should you be looking for? New and exciting developments. Again, regardless of whether they're through us or not, look out for new and exciting developments springing up next door to the major hotspots. As I say, look at the major hotspots and then see what's 5 minutes down the road. That's where you want to be investing. Snap up below market value properties overlooking the same beaches of their far more expensive neighbours. So if you've got a beach which is you've got St Ives one end of the spectrum, you've got the area that we have at the other, you're talking about the difference in 200–300% in terms of value of properties. Now that is a huge amount, and they're 10 minutes from each other, literally 10-minute walk. And that's a huge amount, just because people pay for the fact of, yeah, I've got a property in St Ives. And the locations that stand out are those where it's traditionally been difficult to get a foothold. So, for example, areas where, like St Ives, where you typically can't have maybe a second or third home. Cornwall's notoriously been difficult. As soon as things come back to the market, they get snapped up. So areas like that is where you want to invest in. So my advice to everyone, off the back of sort of like, especially the polls of what we've been doing, is the majority of you seem to be looking to make more income than you're currently making. My advice would be to make a decision, regardless of what that decision is, where it is. Make a decision, because a lot of people procrastinate putting off a decision, and they just simply leave things be. If it ain't broke, don't fix it. That's a very sort of like English way of being. But the problem is that if you look at what you're making in the bank, and typically 0.5%, 1%, it is broke. That for me is something that shouldn't happen. You've got opportunities here, not just in buy-to-let, in other opportunities to make far more than that. So it's worth really starting making inroads. It then has to come from you. It's got to be something that you proactively want to do. Like I say, we can't phone people and force people to buy. It's got to be something that you proactively want and that you want to make money on. Then we can start talking about areas, and we can build up the knowledge of areas for you. Then it becomes down to what you prefer. Do you want to prefer to be slightly bit more hands-on, where you can do a holiday let? You don't mind researching the tax benefits for it. You can sort of do maybe some of the lettings through these particular websites, Airbnb and Home and Away and Homes Direct on your own. Or do you prefer to be hands-off, go to your typical Manchester, your Liverpool, wherever it may be, buy it, be done with it, and don't even think about it for 10 years and just get the income. So there's a lot of potential out there, but everything has to come from you guys, and it's just about actively looking. If you're actively looking, we can help get things moving for you. And as I say, it doesn't matter if you don't deal through us. Obviously, that's what we want. That's how we make our money. But again, there are plenty of companies out there who are very good at what they do. And as long as you're getting what you want, that's the most important thing. Questions, guys? Any questions that you'd like to ask? I think you've got a speech. Again, I say this every time. It should be a speech bubble or a question mark, and you can ask. You can ask sort of questions in there. Okay, so first one I've got here is I don't know much about Cornwall. Okay, I don't know much about Cornwall. I'm not from the UK. Are there any other areas? Okay, so yeah, if you don't know much about Cornwall in particular or the areas, look, it doesn't matter that you don't know so much. We will send independent information out. We don't expect you just to give us a call and we tell you, what property to buy, and then you go and buy it. What we typically look at is to educate everyone in regards to certain areas. So if you're looking for a holiday let, it's going to be a different area than if you're looking for a traditional buy-to-let, day in, day out. So a traditional buy-to-let would be your city centre, whether it be, your Manchesters, your Liverpools, your Leeds, Sheffields. Again, London we feel is dipping still, so we feel that there's still a bit of room to be had in terms of discounts there. But as I say, your traditional city centre buy-to-let, or if you're choosing to go for the holiday buy-to-lets, we're talking a totally different areas there. So we will be looking, for example, such as the Cornwall area and the Cornish coast and Devon and places like that. But again, it does come down to you guys to research as well. We often advise you, we often advise you go and see the area to make sure you have a good gut feeling. Yeah, as I say, there are plenty of things that we can do and we can help with, but we will send out those independent articles to you. But Cornwall is, say, going back to your original question, you don't know Cornwall that well, it's a great area. It's a big place. It's a great area, but again, we can send over the specifics where to go. Next question, so what areas are good to invest except holiday let? Okay, so if you're not looking for a holiday let, again, the areas that I'd still chime on about are the same as, go back a year, 2 years, is still the Manchesters, the Liverpools, the Leeds, the Sheffields. There was a report in the Telegraph last week, and it was an accumulation of a number of different articles, and it just simply said that 51% of students stay in Manchester after they graduate. Now, bearing in mind, there are 30,000 graduates per year across all of the universities and colleges. So 51% stay in Manchester. Now, that's a lot. You're talking sort of over 15,000 stay. Now, even if we thought that was a bit high, which I think that's quite high, but let's say 10,000 stay, you're still talking about a 10,000 extra demand or pressure on properties. So what we're looking at those areas which still have increased demand and a lack of supply. And a lot of people come to us, they visit Manchester and they say, well, okay, Manchester, I see cranes everywhere. Therefore, they're building a huge amount. Just because you see cranes, it doesn't mean that they're building a huge amount. A crane doesn't mean that they're building 10,000 properties. The cranes are there, the building's there, but physically it takes years to build a number of properties. So, for example, we sold one on the river 2 years ago, and it's due to complete end of this year, beginning of next. That's a 3-year turnaround for 250 properties. So what we say to people is, look, just because they've built, there's a lot of cranes, there's a lot of builds, it doesn't mean that there's a lot of completions. You're talking about 7,000 completions per year at the moment. Now that seems a lot, but it's not when the demand for property is double that. So that's a huge amount of demand on one particular property. So I would still go for your typical areas. If you want a traditional buy-to-let, I would still go for the Manchesters, the Leeds, the Liverpools. There's still so much scope to be had. Next question. Are the student flats any good for resale value because of the size of the property? Yeah, good question. Typically, you don't buy the student property to make growth. Your student property is there for one reason, and it's there as a cash cow for income. It's there because you've got a set amount of money and you just want to maximize the income that you can make on it. So, for example, we have student properties that range anywhere between sort of 8 to 10% income, that is. Anything less than that, I wouldn't bother doing. The simple reason being is there's no point getting 5 or 6% in a student property and no growth. You can get 5 or 6% in a residential property. So I would only go for student if you just simply say, you know what, I want to maximize my income. Resale, yes, the resale market isn't as straightforward as the residential market because you have less of a choice of clients. Whereas if you're reselling on the open market, you have people that can live in it. You have tenants as well, and you have investors. So you've got some markets to aim at. If you're a student, you're aiming at investors. That's it. That's the reality of it. So what you have to look at are, what's the investment market for student going to be like over the next few years? Well, the fact of the matter is prices are rising. So the market can't sustain 9 or 10% income for the next few years if prices are rising. So what I would advise people to do is, if you're going to tie up student, tie it up now. Try and get into a 3-year minimum, pushing 5 years ideally, a 5-year income. And I would be saying, don't expect huge growth. You're not going to have your 5-10% year growth. You won't. So let's go round figures. £100,000 property, 9% income. You're making £9 grand a year. In terms of 5-year growth, I would say you're probably going to max out at 110 grand on that property. So 10% over a 5-year period. You potentially could get more, but let's go conservative, 10%. If you had that as a residential property, over 5 years, you could potentially get 130, 140. It just depends what you want out of that particular property. Next question, what about commercial property? When's the best time to go about it? Yeah, good question again. Commercial property. So That's more of a trickier one. Personally, I don't touch commercial property when we're in times like we are currently in, simply because areas or tastes change. And in a downturn, what you've got to look at is what properties will still rent. Well, in a downturn, people still need a roof over their head. But in a downturn, you don't have as many people buying a coffee, for example. So therefore, you start to see independent coffee shops fall by the wayside. You don't. You tend to see people don't buy as many luxury goods in a downturn. So therefore, in a downturn, more commercial property will be basically redundant. And also, you've got commercial property that still doesn't exclude you from paying business rates. If your premises is empty, there will still be rates for you to pay. So they might be reduced rates, but there will still be rates for you to pay. So the chances of a commercial property being empty for a long period of time is a lot higher than a residential property. Even if you've got a good area, you walk around your local town, your local city centre, you will still see properties empty, commercial properties that is. And then go back a week later and they'll be empty. Go back a month later and they'll be empty. There's Chelmsford, where it's my hometown. It's quite a thriving city, and there's a huge commercial property being sold by Savills on the corner. It used to be I think it used to be a Frankie and Benny's or something like that. It's been empty for over a year and a half, and we're in an upturn. So in a downturn, that thing's never going to rent. It's just too big. So commercial property is something that personally I steer clear of. I'm not saying it's terrible. I'm just saying it's personally something that I steer clear of. I think for investors that we deal with, my advice would be to potentially stick to your more traditional buy-to-lets. Next question is, how much should I spend? Again, that depends on you. We cater for all types of clients. We've got clients who are literally doing their first buy-to-let, and they're literally starting off with 50, 60,000 for a student property, or they may come in with 25, 30,000. We can still get people on a buy-to-let then. We try and help out as much as we can in terms of getting them to the right person to speak to in regards to finance and things like that. We have people that range up to portfolios of 10, 15 million plus, and they will go and buy. They will come to us and say that's their money. This is the percentage they need to make, and we will go and put a portfolio together. So it doesn't matter how much money you've got. We will try and work with you and your budget, as long as you're open to an investment, as long as you're open to buy to let. Most people, it's not the money side. People think it's the money side, but it's not. It's actually the emotional side. Most people are financially ready. Potentially they don't realize it, but they're financially ready. They're just not emotionally ready. Next question. What about buy an auction? Do you know what? Auctions, a lot of people got caught up on, and again, I don't know where you live, but in the UK here, we have a lot of shows which are homes under the hammer, and a lot of people saw these homes being sold for 20,000, 25,000, and they thought, oh, I could go and do that easily. But you know what? You're never going to beat the developer. You go to an auction, you will never beat the developer. That's the reality of it. So if you buy an auction, you will be competing with a number of other developers. So let's go round figures. You've got a property on the market and it's going at that auction for 100,000. With a bit of work, you could sell it pretty quick for 150,000, for argument's sake. Well, you as an amateur investor, unless you're a developer yourself, as an amateur investor, time, money, knowledge, you won't be able to do that property up for, let's say, for argument's sake, anything less than 30,000. Whereas a developer who has the time, the knowledge, that's their job. And again, when I say developer, they may simply be a good handyman. They may have people that they know that can do plastering, electrics, water, gas, things like that. But they will know and they will be able to get it cheaper than you. So what will happen is you will go and bid on that up to 100,000 for argument's sake, because you need 20,000 profit at the end. Whereas they can go and bid £110,000 on that particular property, because they have got £10,000 extra because they're saving £10,000 on doing that up. So what basically happens is you will never beat them because they can always outbid you. And the moment they stop bidding, you should have stopped bidding far before they did, because they will always have that advantage over you. And that's the difficulty. People get caught up in an auction, and then what they don't realise, on top of an auction, there's auction fees to pay. Then you've got to still pay your stamp duty fees. Then you've got to do the property up. Then you've got to sell it, so you're going to get estate agency fees, lawyers' fees. And actually, I know so many people who have done auctions, and by the time it comes to it, they've spent 6 to 9 months on a project and they've made £3,000 to £4,000. It's simply just not worth it. And they put a lot of heartache into it. Workmen don't turn up. So can you get a bargain at an auction? Yes. You just need to make sure that you do your research first. But yes, you can make great money at an auction. But typically, you won't beat a developer. Simple as that. Well, look, guys, that seems to be all the questions so far this week. Anything anyone needs, as I say, you can send an email into so that's info@flambardwilliams.co.uk. So info@flambardwilliams.co.uk. And yeah, as I say, feel free to give us a call on 0207 183 0646, 0207 183 0646, and any questions you might have, we'll go from there. I look forward to